This video is going to be a basic introduction into quant trading. Quant trading is basically just another way of saying trading algorithmically. An algorithm is nothing but a mathematical formula that we've developed to give us a result. For example, if we wanted to go to California, we go to travel agents, tell them that we want to go to California, and they can tell us how to get there. That's all an algorithm does. If you don't know where you want to go, an algorithm is not going to be much help to you. And someone who's trying to help you figure out where you want to go is going to have a hard time. So the first thing you need to think about when you're talking about quant trading is, what do you want to do? You can use algorithms and quant trading to trade very short term, meaning market making, seconds, less than seconds, high frequency trading. You can trade by the minute, by the hour, by the day, by the week, by the month. But the longer your holding periods are when you're developing trading algorithms, the more unreliable your information becomes, the more unreliable your result of the algorithm becomes, for the simple fact that you can't get data that is cyclical enough over a long period of time to test properly. So for example, if you want to really see some cyclicality, test a 1-minute chart or a 1-hour chart. But if you start testing a bar chart that's a year bar chart, in other words, say a 50-year bar chart, you have several problems. Number one, 50 years is not enough data points to test. Number two, you don't get enough cyclicality, enough complete cycles in 50 years to get reliable information. And number three, the markets change over 50 years. So what was going on 50 years ago, even 25 years ago, is not relevant for what's going on and how the markets trade today. So quant trading, algorithmic trading, is best used to focus on shorter terms. I would say max would be week bars on a bar chart, but that's problematic. You can definitely do anything shorter than weekly. For instance, day, hour, minute, and then of course high frequency trading would be just tick data. The reason I bring this up first is, if you don't know what you want to do, it's almost impossible to build a trading algorithm that's going to allow you to trade quantitatively. You have to realize that this whole exercise is a statistical exercise, and the database that you use to test your algorithms is going to determine whether or not your algorithm is going to give you any kind of statistically relevant insight into what the market's going to do in the future. Again, past performance is no guarantee of future performance, but you can use algorithms to model the markets, model what they've done in the past, and get some insights. And in order to do that, you need to study data that is long enough back in history to give you enough cyclicality to show relevant patterns. And you really have a hard time doing that with data that's longer than daily. Again, you can do it with weekly, but daily or shorter bar charts, meaning you're modeling the high, the low, and the close of the day. For example, let's say those are the 3 data points you pulled off. There's obviously many others, but if you're looking at those from a daily basis or less, you have a much higher chance of having some successful results that are satisfactory to give you an insight into what the market might do in the future. Now I've logged into the trade output portion of this RBAMresearch.com website. RBAMresearch.com is an algorithmic trading website that produces every day the output from our algorithms and puts them up for people to come and get. You can come and review them for your own purposes. You should never use them to trade exclusively. You should always have your own research and use our reference points, or what we call our entry prices, to validate what you're doing or to help you get trade ideas and so forth. But you should never rely on anything other than your own judgment for entering a trade. So having given that disclaimer, let's take a look at what's going on this page. Again, this is the output from our algorithms. We built algorithms here for these holding periods: 1, 2, 5, 10, and 20 day. And we're going to start with stocks. You see Apple here is to the left. These are the entry prices. You can see today they're not showing anything for 1, 2, or 20-day hold for Apple. If you go down here to Court, you can see they're showing 1958, 1977, and 1996 for these respective holding periods. Now the first thing we want to look at is the respective holding periods. To build and back test an algorithm so that you can quant trade, you need to decide how long you intend to hold the instrument at the beginning before you put the trade on. So that's a critical component. Without that, you can't back test. And it goes to our point that we discussed earlier. When you start to use longer than daily data, and you start to use holding periods significantly longer than months, say significantly longer than 6 months, it gets very difficult to get enough cyclicality over a 5 or 10 year period of time to give you reliable results. So algorithmic trading can be used for a lot of different time frames, but the shorter your time frame, the shorter your hold period, the better you're going to be able to model a particular security, because you're going to have a lot more opportunities to observe cyclicality. So in this particular example, if you wanted to hold for 1 day, meaning buy today and close out by end of day tomorrow, you could look at 1958. These are good for each day they're published, and they expire on that day. So we're looking at older data. This is for the 24th. If you bought Quant on the 24th for 1958, you would hold it 1 day. If it didn't show a profit, you'd close it out at the end of the next trading day. So if it shows a profit, you take it. If it doesn't show a profit, regardless, you close it out at the end of the holding period, which is in this case 1 day, and so forth. For each price, you have a specific holding period. These are all back tested for these holding periods. So if we go down here, you can do the same thing with S&P futures. These are the most some of the most liquid futures contracts in the world, and we offer buy points only on the stocks, but buys and shorts on the futures and on Bitcoin, which I'll show you in a minute, and on the currencies, which I'll show you in a minute. But it's the same basic procedure. You determine your hold period before you get in the trade. You pick out a price here, 2 day, 5 day, 10 day, 20. This is indicating a short for this particular day. And this is a reference point that you can compare with your own research and decide whether or not that particular point validates your research and use it or not, depending on how you want to trade. You can go down here to crude oil futures, see the same thing, gold futures, and treasury bonds. Moving on now to cash forex, the same thing. All this is essentially the same output. These are all generated with essentially the same algorithm, but not the same tuning. You build an algorithm, and then you tune an algorithm. And it's not necessarily optimizing it, you're just tuning it to get what you want out of it. And each individual security requires some separate tuning. In most cases, they're not too far off. It just depends on what you're trying to get out of it. But you basically can build an algorithm for the entire these major securities. We're talking about stocks, forex, futures, and so forth, and then just tune that one algorithm so that it works across markets. It's not possible to do with everything, but you can do it with some basic algorithms. If we go further down here, we show you crypto, and today we're looking at Bitcoin, and there's a buy all across the board on Bitcoin. Each day on this RBAMresearch.com, you're either going to get a buy or a short for everything but stocks. And for stocks, you're going to get just buys. Now, the reason I showed you these variety of securities, or this variety, is to show you what you can do with an algorithm once you have it built. It's impossible for any single analyst to follow 190 stocks, which is what we cover, the major futures contracts, the major currency pairs, and major cryptos. It's impossible for anyone to do that Monday through Friday and post results before 7 a.m. for all of those different securities. You would need an army of analysts to do that. This sheet that you see here on this screen was compiled in less than an hour. The algorithms only took seconds to calculate. It took some time to input the data, the historical data, but the whole thing was done in an hour and posted on this computer. So the amount of time you save once you build an algorithm is ridiculous. And that does two things. Number one, it gets you out of your desk before midnight every night. And number two, it allows you to focus on the whole reason you built the algorithm in the first place, which is to quant trade with it. Focusing on algorithms is a huge mistake. The purpose of an algorithm is to quant trade, is to actually trade the markets and make money. And the further you get away from that, the further you're getting away from the whole reason you got into the markets in the first place. The markets are so fascinating, and the amount of time that you can devote as a hobby to algorithmic trading, to quant trading, to building algorithms is essentially a lifetime. It's a fantastic endeavor, especially if you're into it, and especially if you like math. But you want to keep in mind when you're designing these algorithms, you want to look at two things. Number one, you want to look at how many trades does an algorithm give me for a given period of time. And number two, what is the real profile that I expect to get from those trades? So in other words, ask what you want for results before you contemplate building an algorithm. What good is an algorithm that gives you one good trade a year? That's, for most people, that's not going to be any good. So you want to get X number of trades per year, or per period of time, say per month, or even per day if you're trading intraday. And you want to see what your average profit might be. And you want to see how well your gut can handle a longer term holding period. Some people cannot handle longer term holding periods when they're trading. It's just not possible. But the fact is, the average profit's almost always going to be higher the longer the holding period. That's not always true, but it's usually true. So in other words, for the same amount of contracts or the same amount of position size, you're going to make more money if you're willing to hold the position a little longer, at least in the algorithms that we build here. So your gut, how long you can stay in a position, should be checked before you build an algorithm. How many trades you want to put on for any given trade period, day, month, year, and the amount of capital you have. If you're trading a small amount of capital, you want to trade like Walmart does. You want to move volume every day because you can turn your capital over every day and make money on turnover. If you have a significantly large amount of capital, you can put on one trade a year, two trades a year, three trades a year. And honestly, if you're going to do that, you really don't need to quant trade. There's a lot of other ways you can trade, fundamental, technical, that would allow you to put on those big sweeping trades. But the beautiful thing about quant trading and building algorithms is it allows you to start with a significantly less amount of capital, not undercapitalized, but a less amount of capital, and trade like a businessman, meaning trade every day, or trade every week, or trade every month, as opposed to waiting for one big trade a year. It's an enormous fallacy to think that trading infrequently is a better way to trade. It's a better way to trade if you're sitting on hundreds of millions or billions of dollars. And if you're a fantastic technical or fundamental analyst. I don't necessarily believe, in my opinion, it's a better way to trade if you have a fairly small account, or if you're not that great at technical or fundamental analysis. Make no mistake about it, technical and fundamental analysis works, but it can take decades to learn. Most people are no good at it, and it's never going to give you an exact $19.58 entry price on Quant. Now again, this is a recommended reference point to follow, but I'm not aware of any fundamental or technical way to analyze a market that gives you an exact price. I'm sure there's some out there, but I'm not aware of them. These give you exact prices. These algorithms give you exact prices every morning by 7 a.m. All you have to do is log on to RBAMresearch.com, open an account for free, no credit card required, and you get these prices. Once you learn to follow these prices, you'll realize the importance of having a specific price to look at, number one, and number two, of being able to get those prices with virtually no work. The work is in building the algorithms. The using of the algorithms, it's virtually no work. You just look them up, and then if the market gets there, you validate those entry prices with your own research, whatever that may be, and you go from there. Again, you never rely on anything that you get from somebody else to determine when to enter a trade. Either consult a financial advisor. It's your money. You trade at your own risk. So these are just reference points. But they're any reference point that you validate yourself as being worthy of observation should improve your trading over time. So all of this is available every morning at 7 a.m. RBAMresearch.com. Keep in mind several things. All of the information you see here every day is for entertainment purposes only. You always trade at your own risk. We follow 190 stocks. We follow the major forex pairs, crypto, and the most liquid futures contracts. They're all updated every weekday morning by 7 a.m. at RBAMresearch.com. And again, No credit card required. You just sign up and you get it for free. If you like this video, please hit the like button below. If you feel like it, please subscribe. And again, not to be repetitive, but this is all for entertainment only, including the entry prices, and you always trade at your own risk.